Joe LaVorgna, I want to talk to you about the mystery of this August, the mystery into Q4 as well. How opaque is your Q4 right now?
It's somewhat opaque. Look, the economy's done very well in the past 4 quarters. GDP growth has been over 12%, but I've been of the view that the economy was at peak growth around Q2 and things are going to moderate. But even so, Tom, it's hard to see growth still not being really robust in the fourth quarter. I'm more worried about growth in 2022. And that's what the U.S. Bond market and global bond markets are sensing, that growth is going to weaken quite sharply with this bull flattening. And inflation will be transitory. That's what the markets are telling us.
That's what the markets are telling us. And is it a weakening back to potential GDP or let's say 3%? I mean, what's the level of weakening, the scale you would presume?
This year growth, I thought coming in, we'd have growth at 7, maybe even 8%. But next year, I'm thinking growth is only 2%, maybe even less.
Wow.
Which isn't far from the administration's longer term forecast. And that reflects the fact that we're borrowing from the future because we've had people that have been unable to spend until recently because of the pandemic. They've been locked up. They brought spending forward. We see that in goods purchases, which are about 4 to 5 points above their long-term GDP trend. And it's been predominantly consumption-led. Consumption in the last 14 quarters, if you look at 14 months rather, Tom, from when the savings rate went from 34% now down to 9%, we've had annualized consumption gains of 21% real. That's amazing. It's mostly in goods. So we're borrowing from the future, and that's why growth next year will slow quite sharply.
Joe, let's take your view of the world, and I'll ask you a basic question. How do you think the Federal Reserve operates in the kind of environment that you've just described?
They don't do anything, Jonathan. They stay on hold. They continue to pump liquidity in the system. They don't taper. They don't tighten. What we've seen continually since those late March, early April highs in 10-year yields is the market pricing the terminal rate significantly lower. That five-year OIS we've talked about was around 240 back in early April, thinking the market would basically, or the Fed rather, would tighten rates like they did in the last cycle. And just the other day, we were below 150. So the market's thinking the Fed does nothing. Yeah. And my guess is we don't get a tightening until after the next presidential election.
John, and then this goes right to the heart of what you mentioned before, which is the gentleman from St. Louis disagrees, just flat out disagrees with Joe LaVorgna.
As does the former head of research, I imagine, over at the St. Louis Fed as well. Joe, you said
that's okay. I don't mind being the other side of that trade.
I imagine you don't mind that at all. You said no tightening, no tapering. You don't think we get a taper here, Joe, at all?
Not until we know what the contours of a budget deal look like, because the Fed will treat a lack of a deal as being contractionary. And even though we're in the midst of debating what happens on the infrastructure side, the bigger part of the package is this family welfare bill. And we're not going to know what that looks like if we get it, and it will likely be through reconciliation until maybe mid-October. Early November. So, no, I think the Fed's going to sit and wait, see how things evolve. And it's going to be really hard, Jonathan, for the Fed to taper in a slower growth environment, and especially if over the next few months job growth slows, which I expect as well.
Just fascinating. Joe and Lisa, this won't be lost on you. No tapering. The other call there, no rate hike until after the next election.
Yeah, I just want to add one other thing. You know, that sounds aggressive, but if you look at the last 2 cycles, the average time from the last rate cut to the first rate hike was 7 years. So this isn't really that unusual if you look at the last couple of cycles.
So, Joe, why are some people wrong who are saying that the balance of risks is too much higher inflation, especially with the Fed so dovish and so willing to wait? What is wrong with that call? Because it seems like you disagree.
Yeah, well, the thing is, we've never had basically a global lockdown of the economy where we've gotten these bottlenecks. And, of course, demand has been much stronger than people expected. The government has provided a tremendous amount of assistance. So it's easy to see why prices are rising. If there's a concern on inflation, and if I'm wrong on inflation, it's because perhaps we just spend too much. This is sort of the Larry Summers argument. And maybe evidence of that is seen in what the CBO next year was saying the output gap looks like. They're forecasting an output gap of almost 240 basis points, meaning the economy is 2 points above its long-term potential. That's the highest since '71. So it is possible, if we get more fiscal stimulus, you could build this inflation dynamic in the system. But I think most people just aren't fully appreciative of the unique situation we're in, and the fact that much of the liquidity we've had to this point has gone into assets, both equities and, of course, real estate.
Joe, I hate to use the word transitory, but let's talk transitory. And at what point you start to look past some of the near-term influences on the economy? I'm talking about supply chain disruptions. The gentleman from St. Louis, as Tom said, was highlighting this as one feature that forces monetary policymakers to be more nimble. How do you factor in some of these disruptions that seem overly persistent and persisting longer than many people had expected?
Yeah, I would just say, I would just give it time. I mean, the thing is, we saw with lumber, for example, which was the poster child for bottlenecks, where prices have basically collapsed as the mills were able to reopen. And I've argued we're going to see that more on the semiconductor side and other parts of the economy. It just needs to take time. The expectation side of it's important. And when we look at the tips curve, that tips curve is actually inverted. So it's not to say the markets are always right. There's just no evidence that anybody believes this is permanent. And because expectations oftentimes can be self-feeding and self-sustaining, those expectations are very likely to keep inflation low. And then as supply comes on, you'll start to see those prices moderate.
Joe, none of this is in the economic textbooks at Vassar. This is all absolutely original that we're dealing with right now. How do you interpret the real yield? Are you looking at the nominal rate? Or are you taking out the inflation expectation? Which of those two dynamics will adjust the real yield?
Well, I would say just focus on the real yield. The real yield has been falling as inflation expectations have edged up a bit. And that's sort of evidence, Tom, right there. The market does not believe that you're going to have very, very strong growth going forward. It's I hate to say these words, but it's the secular stagnation thesis. That's really what the market's saying. And you see it more broadly just in the slope of the curve, as you highlighted, both in the U.S. and Germany and elsewhere. You've got a bull flattening of the yield curve. So that's really not an inflation story. It's a growth story. And of course, equities benefit from the fact that there aren't any alternatives, and there's a tremendous amount of liquidity in the market.